Okay, good evening, everyone, and welcome to JID Investments and PGI Self-Directed webinar on investing with retirement accounts and understanding passive real estate investment. Tonight, we have the pleasure of John Park Company. He is the president of PGI Self-Directed and a industry recognized expert in establishing and leveraging retirement accounts for investment purposes. We also have John Rubino, founder and COO of JID Investments. Passive real estate investment company. This evening, we'll be spending about the next 45 minutes to an hour or so providing an overview of investing with retirement accounts and understanding passive real estate investment. Here is a quick agenda of some of the things that we're going to be going over this evening. John Park and John Rubino will have a few minutes to kind of introduce themselves, tell you a little bit about who they are, what they do, and how their services may be able to benefit you as investors. Our presenters, John Park, as I mentioned, president of PGI Self-Directed, John Rubino, founder and COO of JID Investments. John, we're going to go ahead and start off with you. If you want to talk a little bit about what it means to leverage retirement accounts for investment purposes and educate our folks.
Hey, John, we got you on mute there.
Okay, can everybody hear me okay?
Yep.
Okay, thank you, everybody. Appreciate your time. And one of my styles when I visit with folks is I like to do a little bit simpler and shorter and, just get the main bullet points across. And for those people who are interested, John and David will be able to give you my contact information and to get on a phone call and kind of go into a little bit more specifics with your personal situation if you're interested. But self-directed IRAs and solo 401k plans, they've actually been around a long period of time. It used to be that nobody had heard of them. Now they're starting to become a lot more popular for lots of different various types of investments, including real estate tends to be a very popular use of these plans. And you really have two different options. So when we go through these, I kind of want to explain what camp you might be in if you're interested in. So for people who are not self-employed in any way, shape, or form, meaning they're W-2, they're retired, etc., they would gravitate towards a self-directed IRA product. And we'll talk about what options you have with that. If someone is self-employed, even on a part-time basis, even if they're a W-2 employee, but they have a side hustle, a side gig, etc., they would be able to most likely qualify for an individual 401k plan, or what a lot of people just refer to as a solo K. And we'll kind of talk about the moving vehicles with that. What PGI does, and I always want to be transparent and blunt about this, is there's multiple ways you can self-direct your retirement account. Let's get the 800-pound gorilla out of the room. What PGI sets up is a checkbook control model versus a custodian control model. The custodian control model is if somebody calls me and says, hey, John, I don't want to use your services. I certainly don't want to pay you any money, but I want to set up a self-directed IRA. And can I work through a self-directed IRA custodian to set that up and in effect not use your services? I'd say, yeah, absolutely you can. Now I'm going to also talk about why you might want to use the services of PGI if you're interested in a self-directed plan. But do you need to have checkbook control? No, you do not. But there's two reasons why most people will gravitate towards a checkbook control, generally speaking. One is that in this industry, the custodians on the IRA side do their best, but inevitably people get extremely frustrated with that process because they have to go to the custodian for every single thing they want to do with regard to an investment and then getting paid investment returns. And typically they just start throwing up their hands and they're pretty frustrated with that process. Probably the more practical issue for anybody who's interested is the fact that when you typically have your funds on deposit with the custodian, meaning you don't have the checkbook control yourself, you're going to end up paying a lot more in fees because the basic feature you want to think about with a self-directed IRA is that when the custodian controls the funds, they're touching your activity more, they're touching your plan more, they're touching you more, etc. And when they touch you more, they're going to charge you more. So typically a checkbook control model is pretty attractive to a lot of people. They just have to follow some, what I consider fairly basic IRS rules with regard to how they can invest the money. I can tell you right now, anything associated with John's group would not be an IRS prohibited transaction, is the term the IRS uses. So it wouldn't trigger any kind of investment problems that it's not a permissible investment to make. But with the checkbook control model, the cost savings can actually end up being quite big over a period of time. But that's the only thing my company does, is we set up both the IRAs and the 401ks with that checkbook control model so that you're not working through a separate company and paying additional fees for those kind of features. Freedom. With both, you're going to have total freedom, because in the case of the IRA, we have two structures that we're going to talk about. But in both cases, whether it's an IRA LLC or an IRA trust, you are going to be the kingpin controlling those funds. In the 401k, it's a very simple explanation. If you qualify for that 401k and that plan is set up, you most likely will designate yourself as the trustee of that plan, meaning you control the checkbook, you control the activities. Again, you just have to follow certain IRS rules, but you're going to actually be able to control that checkbook, control that wire capability, do the transactions you want with whatever investment that you're wanting to make. So before we get to the IRA products, 3 things to keep in mind with these 3 boxes is you have the checkbook control, you have the freedom to invest as you see fit, and you have the cost savings. Real quickly before we go to the next screen, when I talk about freedom, a lot of times people who are not in this business at all, they'll say, well, what am I limited to? What can I do? What can't I do? And with the permission of the group, I'm just going to touch on a few areas that you'll want to stay away from with whether you have a checkbook control model or not. And the first one is what the IRS calls disqualified assets. It's pretty simple and pretty straightforward. If you have an IRA, the IRS says, as far as assets go, you cannot invest into life insurance contracts and collectibles. Collectibles would be things such as fine rugs, artwork, wine collections, the list goes on. But if it's a collectible or if it's a life insurance policy, your IRA cannot invest into it. So if somebody calls me and says, well, John, what can I not invest into? I'm actually going to turn the table on that conversation. And I'm actually going to say, it's not really what you cannot invest into, because that list is extremely small. Really, the better question is, what can you invest into? And that's an unlimited list of assets that you might be able to invest into. On the 401k side, as far as disqualified assets, the only thing, technically speaking, the IRS says you cannot invest into are collectibles. Now, notice I said with the IRA, it was collectibles and life insurance contracts. Well, technically, when I set up 401k plans for folks and do the documents for that, you pretty much cannot invest in life insurance either, because I don't include that as an option. Why don't I include it as an option? I'm more than happy to if somebody wants, but generally speaking, 2 reasons. One, for the 401k, if I include the ability to invest into life insurance, I have to make sure I educate the client on what's good and bad and what the rules are about how much money you can use to invest in life insurance contracts. But realistically, doing this 16 years, I think I've had 1 person ask. So even though a 401k can technically invest into life insurance contracts, I do not set up the plans to allow the client to invest into life insurance unless they ask me about doing that. Next thing is what's called disqualified individuals. And you just want to think of a vertical and a horizontal plane crossing each other. And you, as the account owner of that IRA or that 401k, you are what the IRS calls a disqualified individual. That sounds kind of bad and nasty. It's not, and I'll explain what that means. But on that vertical plane, if you're married, your spouse is a disqualified person. If you have any bloodline descendants, your children, etc., they are disqualified to the plan and to you. And if you have parents, grandparents above you as bloodline ascendants, then they are disqualified to you. So for right now, I just want to create a visual. If you're setting up a self-directed retirement account, what you would want to say to yourself is, generally speaking, there's ways to make it permissible, but generally speaking, I want to make sure I don't do any investment that's going to involve my parents, my grandparents, myself, my spouse, or my kids, where they would be receiving any benefit. Let me burrow down a little bit further. Let's give 2 easy examples. Let's say somebody says, well, hey, my kid is here in Virginia and they're going to go to University of Virginia or Virginia Tech. And what I thought I would do with some of my retirement funds is buy a condo or a townhouse, and he or she can live there while they're going to school, pay rent, but also bring in friends who will pay rent that will be going back to my retirement account. That's not a problem, except for one big red flag. Your child can't be there. They would be receiving a benefit from your retirement plan, and they're a disqualified person to the plan. So when I have people try to argue with me on that, and they go, well, my kid's going to pay rent, I'll say it doesn't matter as far as the IRS is concerned. Your plan owns that asset. Your child is a bloodline descendant to you. They're considered disqualified. They just can't stay there. It's as simple as that. Reverse engineer it. If you had a parent, grandparent, where maybe it was a divorce or a widow situation, same thing. You can't necessarily, buy an investment property, in this case, a rental property for them to live in, because they're disqualified. So I just tell people, when you go up and down that ladder on the vertical side, just kind of stay away from doing things with any of those folks, because there's a good chance you could trigger a prohibited transaction. Now, remember, I said there's a horizontal and a vertical line. So we talked about the vertical. The horizontal line are people like brothers, sisters, aunts, uncles, nephew, nieces, cousins, strangers, friends, business associates. Those are all people by IRS definition that are not disqualified to your plan. So if somebody wants to do an investment with their sister, their brother, a friend, etc., that's totally fine. The other person doesn't have to use self-directed plans. They can use self-directed plans. Bottom line is, if they're on the horizontal plane, you can do anything with those folks. That's not going to be a problem. You just have to stay away from the folks I mentioned on the vertical line of the bloodline ascendants and the bloodline descendants. And David, with that, if you want to go to the next screen, and we'll get to the actual structures that we use. So the first one is an IRA LLC. Everybody and their dog and their cat who's in this business utilizes an IRA LLC structure. It's the one, think of it as the Cadillac, the Mercedes. It's the one that's just been around. It's been upheld through court, IRS court case, etc. It's totally permissible. You just have to follow the rules. But how does it work? So now if I'm working with a client, we'll say they're in Virginia, and they say, John, I think I want to do the IRA LLC. Explain to me in a nutshell what that means. So one thing about IRA law that everybody has to know is that an IRA has to be, I'm going to do this in quotations, held through a custodian. For those of you who have IRAs right now, the money's not under your mattress. It's not necessarily just sitting in a personal bank account, at your bank. It's being held through a company or a bank like a Schwab or a Fidelity, or a bank that sets up IRA accounts. They're the custodians. They actually have to report to the IRS each year 3 things. 1, what kind of contributions you make into your IRA. 2, what kind of distributions, if any, you're taking from your IRA. And 3, the fair market value of the assets within your IRA. Let's address the fair market value, because this is going to kind of give you a good visual of how self-directed plans work. When a self-directed IRA has assets like real estate, it's not like it's at Schwab and they take a picture of your account on December 31st and have a value. You're investing into real estate, and on top of that, you're doing it through a checkbook control IRA LLC structure. So the custodian doesn't really know how you're investing the money, if you're doing things correctly, but they're going to reach out to you every year, and they're going to say, hey, we need to know what the fair market value is of the assets held by this IRA LLC that you're operating, and you'll provide them a number for that each year. It's not a difficult process at all. In fact, I think sometimes the custodians make it too easy. But those are the 3 things the custodians, including a self-directed custodian, have to report: contributions, distributions, fair market value. So now let's go back to the self-directed IRA custodian. These are not companies like Schwab, Fidelity, etc. And why? Schwab and Fidelity have 0 interest in getting involved in this business for 2 reasons. 1, they view it as a compliance risk for them, because they're now putting their name behind a self-directed plan that you're investing into, and they don't necessarily want to have you do things that might be incorrect under IRS rules. Two, which is the more important one for them, they don't make any money off of you when you're investing into, for example, real estate syndications. There's no way that they're able to, well, I suppose they could, but there's not really a tangible way for them to monetize that process and still keep their fiduciary role as a custodian. So because I said an IRA has to be held through a custodian, and because companies like Schwab and Fidelity, et cetera, do not do self-directed plans, who are we going to? Well, the good news is I work with 5 different custodians. All the custodians I work with are IRS approved custodians. So they already have the blessing from the IRS to be involved in that business and to serve in that role as a custodian. So there's no issues there. But what the custodians don't do is none of the self-directed custodians sell you investments. So they will never be pitching you for stocks, bonds, mutual funds. You pay them an annual fee to serve as the custodian. They provide that role for you and for your IRA and do the reporting to the IRS. But other than that, they don't have their hand out selling you investments because they don't do that. They're just serving as the custodian. Now let's burrow down to the IRA LLC and talk about, from a 50,000 foot view level, how this works. So I'm going to pick on David, and I'm going to say, David calls me one day and says, John, hey, I was just blown away with your presentation. Haha. And he says, I want to do an IRA LLC. How does it work? So what would happen is we would choose a self-directed custodian that's going to house the funds. But let's say David has an IRA account at Charles Schwab, and he says, hey, John, I got $1 million in my IRA. I want to do some investments with this Rubino group. You know, I only need 150,000. Should I be bringing over the full million? Should I bring over just like 150,000? What should I do? I'm going to say, well, it's totally up to you, but I'm going to highly recommend that if your investment amount is 150,000, no sense bringing over the $1 million when 150,000 will do. Let the other 850 do what it's doing, you know, with Charles Schwab. Bring the 150 over to the new custodian. Now here's where my company comes into play. What PGI then does is, with this type of a plan, we're securing for David his Virginia LLC in this case, because he's in Virginia. We're securing the EIN for the LLC. In some cases, most importantly, we're providing the operating agreement, which has very specific and has to have very specific IRS language as to how that LLC is going to be operated. Because the key factor on the IRA LLC is, for those of you who are familiar with LLCs, you know there's a member and there's a manager. Typically, there could be multiples, but let's just keep it easy. There's typically one member and one manager. The member, by definition, is the owner of that entity. The manager, obviously, is the person who sits at the desk, pulls out the checkbook, looks up bank account balances, wires money, makes those day-to-day decisions. So when, in the case of an IRA LLC, and this is very clear legal distinction, is the IRA itself, which is not a person, owns the LLC. David now, as the manager of that LLC, can invest those funds. He just has to follow those IRS rules we were talking about, but he can invest those funds as he sees fit. Then he makes that investment with Rubino's group, and he just has the returns come back to his LLC. Now, David might say, well, whoa, wait a minute, John. This LLC, though, is not my IRA. You're right. It's not your IRA. But when we set this up, your IRA legally has assets held by the LLC. So the only money that goes into an IRA LLC account are those funds coming from are those funds coming from the IRA for investment purposes. David's not allowed to put any personal funds in there. He can't use it to run a business. It is only an IRA LLC structure, and that LLC is only to make investments on behalf of the IRA. David makes his investments out of that LLC. He gets his returns back to the LLC. And David says later, hey, John, if I was done with my self-directed plan, how does that work? How do I unwind it? At that point in time, David would move monies back from his LLC account to his IRA account with the custodian. And then he would ask, most likely, a company like Charles Schwab to reach out to the custodian to request a transfer of funds, non-taxable, non-reportable, back to his IRA account at Charles Schwab. But hopefully that flow, I went through that fairly fast, but hopefully that flow made sense, that the funds are going to go from the IRA or the 401k, wherever it's coming from, brought over to the IRA account. moved into an LLC account, you as the account owner will make those investments. Next structure is an IRA trust. And I'm not saying this with any patting on my back. We're one of the few companies that does the trust. And let's talk about the legal distinctions of how the trust works. So with the IRA LLC, we talked about the LLC being owned by the IRA and managed by the account owner. With the trust, the flow is exactly the same, but the legal semantics are different. Now, if David has the IRA trust, he is going to be the trustee of the trust, same role as the manager of an LLC, just different titling. The IRA, instead of being the member of the trust, like it would be with an LLC, it is called the grantor because it is granting the IRA funds to the trust. Flow works the same. In David's case, the monies go from Charles Schwab to the custodian, which has to go there first. Then the IRA trust account is set up. The funds are sent to the IRA trust account. David then makes those investments, and he can do JID investments to his heart's galore, any other investments that he's thinking about doing, as long as it follows IRS rules. Now the question, why would you have two? What are you trying to sell to people that they don't need or that they do need? And that'd be a very logical question. So with the IRA LLC, there are some states, Virginia is not one of them, but there are some states that have very expensive fees associated with forming and keeping an LLC. For example, if I'm working with somebody in the state of California, they have to pay the state of California $800 a year, which sounds criminal, but they have to pay $800 a year just to have that LLC registered with the state of California. Well, in that case, if I'm talking to somebody in California, I'm going to suggest that they strongly consider the trust, because the fee structure on the trust is not significantly higher than the professional fee for the IRA LLC. And what do they avoid? They don't have an LLC. So they don't have those expenses with that state. And now in Virginia, it's only $100 to set up the LLC. The annual fees aren't much at all. It's really not a big problem. But there's also pros and cons to using the IRA LLC. So if I'm talking with one of you on the phone separate from this, we would just go over your situation. I would explain the fee structure for both. I would also explain some pros and cons to both the LLC and the trust so that you could make the decision that fits your style most. But if you want to walk away from this presentation and say, as a general rule, I'm in Virginia, between the two, what would you recommend? For someone in Virginia, I would say, generally speaking, I would suggest the IRA LLC. If it's a state that's going to have a lot of higher expenses associated with it, I would suggest possibly the trust. Otherwise, they both operate the same in making investments. Next, Solo K. This is a great plan, provided you qualify. And unfortunately, in this business, there are some companies that pitch the 401k and maybe don't really get too concerned about whether or not somebody qualifies. So I'm going to pick on David again. David is a young and strapling young man, and he's just energetic, and he's got a W-2 job, but he's got a solo business on the side. You know, he's doing the side gig, and he says, John, can I qualify for the 401k? And my first thing I'm going to say, and I paraphrase basically what the IRS says, is I'll say, David, so tell me about your business. And he tells me about his business. And I ask that, one, because I'm interested, but two, I also want to get a feel that David actually would qualify for the 401k. But the IRS is basically going to say is, are you on either a full or part-time basis conducting an activity with the intention of making profit for yourself? If the answer to that is yes, then generally speaking, you will qualify for the 401k plan. Now, what does it mean? Well, solo means one. So keep in mind that if any of you think you qualify, one of the first things you want to ask yourself is, self, do I have any employees? If you do, Solo K plan is not going to work for you, because generally speaking, if you have employees, you're probably not going to want to set up a 401k plan just to make self-directed investments. And I can get into that conversation more with folks if you want me to. But it's intended for somebody who is fully self-employed, no employees. Now, you could have legitimate 1099 people who do work for you, but it has to be truly 1099 people. But here's now some of the benefits of the 401k. Is number one, if you qualify, you can certainly put a lot more into contributions, potentially with a 401k plan, than you ever can with an IRA. Number two, I don't tell people what to do, but your 401k plan allows you to take out loan provisions. Some of you have probably done that before in a W-2 position where you're in a 401k plan and they say, hey, you can take out a loan from your 401k for anything you want to do. You just have to pay it back. And in the case of that business, they're going to make sure you pay it back because they're going to take it out of your future paychecks to pay back the loan, but you can do it. Same thing with a solo plan. You just have to pay the loan back based on the IRS's terms with that, but you have the ability to take a loan if you want to. Your IRA, you're not going to be able to take out a loan. Number three is with investments of any kind that are considered non-traditional, you're not going to probably get yourself ensnared in a situation where the 401k is going to incur taxes. Now, this always sounds like a foreign concept to most people because they go, well, hey, John, I have a 401k or I have an IRA, and I've always been told that I'll never pay taxes until I start taking the money out in retirement years, like if it's a pre-taxed IRA or a pre-taxed 401k. And that's absolutely true. There are, though, a couple tax, I don't want to say gotchas, but I'll just say it, gotchas, that where an IRA or a 401k can incur a tax. I'll visit with you more about that, or if anybody wants to ask questions during this call, we certainly can. But just know that there are a couple times and a couple situations through investments where an IRA may owe a tax or a 401k may owe on a tax. But out of those two potential taxes, one of them, it's called UDFI, doesn't even apply to a 401k. It's exempt. So that's another great benefit of the 401k. And then bottom line with the 401k, you really do have the freedom and flexibility because we can set it up where your plan is at a bank. It can be set up at a brokerage firm. So if somebody says they want to be able to use the 401k to invest in JID investments, but then also use it for stocks, bonds, and mutual funds, that can absolutely be done. So the three products, just to kind of sum up, those three products are going to be the IRA LLC, the IRA Trust, and the Solo K. The other boxes you see I'm going to touch on real quickly. In fact, let's go to 6 first, is company 401k. So we can set those up. But what I mean by a company 401k is if one of the prospective investors says, John, love what I heard, but I have a company. I got lots of employees. Could my company plan that has lots of employees, could it be set up with a self-directed option? It can. Generally speaking, I'm going to tell somebody it probably is not going to be in their best interest for a lot of reasons to set up a company 401k plan for the sole purposes of being able to self-direct into investments like real estate. But the visual I want to create is that if somebody is interested in having that conversation, it's potentially possible to do, and it potentially might be beneficial to them. That'd be something I'd want to just talk to them about to kind of give them the good and the bad about that kind of an arrangement. Income strategies. One thing you should know that if you're working with PGI does not sell you any investments. Good, bad, or indifferent. The only thing we do is set up these plans. So we're familiar with a lot of the different types of investments that one can make out there, but we're not personally pushing investments. We don't get compensated on anything from an investment standpoint. Your fees that you pay PGI has nothing to do with account balances or anything else. It's just a professional fee to set up the structure. But there are some income strategies that I can talk to people about if they're thinking about, are there ways I can potentially save and have more tax-free money in retirement years versus less tax-free money in retirement years. With CPA assistance, John has a very good associate working with him by the name of David Shad, who is wonderful and can provide significant assistance. I'm sure, I don't want to speak for John, but can probably provide significant assistance to anybody who might want that assistance. If you don't have somebody, or if you're looking for somebody different to possibly use for tax advice. I have this in here because I just work with a lot of people and all over the country. And sometimes I get people who say, hey, my CPA doesn't really understand this. And is there anybody that you might be able to refer to me? So I have that there only for that reason. But quite honestly, David, if you do decide to do something with JID, David's a wonderful person and would be probably more than happy to assist you as well. So with that, I've done a lot of talking, and I tend to talk fast, and I tend to be boring sometimes. So if with John and David's permission, if there's anybody who has questions, we can throw out some questions now, and then also they'll provide you with my contact information. And I'm more than happy to set up a call with somebody, because when I do a phone call with somebody, here's what you're going to get, good or bad. I don't like companies that do a 10-minute elevator pitch when it comes to money, because I think you should have a thorough explanation of what you're doing and how these self-directed plans work, more so detailed than what we've been talking about here. So I tend to do at least a minimum of a 30-minute call with folks. Now, if I have somebody who calls me and says, John, give me the 10-minute elevator pitch, I'll give them the 10-minute elevator pitch. But my preference is to actually have a conversation, because I don't think it should just be a 10-minute elevator pitch to make a decision. And with
Hey,
that,
John, thanks. That's a lot of really great information. We do have a couple questions from audience members. The first comes from an active duty military member who has a home of record down in Florida and a current residence in the state of Virginia. Are there special rules that would apply, or is establishing an SDIRA or trust in one state better than the other? Or how would that process work?
Yeah, generally speaking, I have a few clients who are military, and what I always kind of go back to them on is, what does the government recognize as your official mailing address? Whatever the government recognizes as your official residence for tax purposes, that's probably the state we would use. And to give you a good example is, I have a client who, he's no longer in California, but he was military. He had a home address legally set up in Texas, but he lived in California. And California is extremely strict because they always want money. And I don't mean that in a bad way. It's just true. They always want money. So in his case, his concern is if I set up the IRA LLC in California, are they going to come after me for the $800 per year? So we were talking about his resident situation. And because the government recognized for tax purposes that he was a resident of Texas, we set up the LLC in Texas, not California. But yes, that's a great question. I don't get it that often, but I would say there's got to be something that the client would have that would show where his residency is for tax purposes.
Okay, perfect. And the second question that we do have from one of our audience members is, currently in the state of Florida, he would like just some brief guidance on the state of Florida. If you would prefer to connect offline, we can certainly do that. But if you have just a moment and are able to speak on the state of Florida, that would be great.
Yeah, so if we're talking about the IRA LLC, I can tell you real quickly, it's the setup cost for the LLC is $125. Excuse me, Florida is what I call one of those tweener states. They're not expensive, but they're not cheap. So Florida is a little different in that they only charge $125 to set up the LLC, but then they charge somebody $138.75 per year to maintain it. So when I'm talking to somebody with Florida, I'll say most of my clients in Florida use the IRA LLC, not the IRA trust. But from a cost saving standpoint, especially if somebody's planning on doing it for more than 4 or 5 years, which most people do, they'll probably save more money doing the IRA trust in Florida versus the IRA LLC in Florida. One of, by the way, if you don't mind, David, one other thing that might be of interest to your listeners is where to get the LLC. Now, I'm usually always going to tell somebody that, logically speaking, generally speaking, you should form the LLC for anything, for whether it's for a business or for this IRA LLC, should be formed in the state in which you reside. But I do make some exceptions with that, and I don't give legal advice, but I feel comfortable with this. So let's say somebody was doing cryptocurrency and they lived in a state that had a high LLC expense. And they said, John, I want to do the IRA LLC. I don't want to pay all this money to the state. Could I possibly go to, if I have a friend, and the reason I say friend is there always has to be somebody who has a physical address in that state that serves as the registered agent in case the LLC has ever served notice. But I don't have a problem if somebody says, hey, I live in California, but my brother lives in Missouri and it's only $50 to set up the LLC. I'll say, if you're doing something like crypto, I don't see any issues with that whatsoever. When it comes to real estate, though, people do have to be careful because every state can have different rules. And what I mean by that is John and David, and most of you folks might be in Virginia, but you might say, well, what if I went and looked at property in Maryland? Well, if you have a Virginia LLC, you're going to most likely have to register your Virginia LLC. They call it a foreign LLC, but basically you can look at it as an out-of-state LLC, but you may have to register your out-of-state LLC of Virginia with the state of Maryland just to go in and buy property. But in some other states, you don't have to. It's not considered doing business. They just say, hey, you can come in and if you want to buy property, you can buy property. They're all kind of case by cases, but the reason I wanted to mention it is if you are in a high state with an LLC cost and you do possibly want to form an LLC in another state, it may be wise to do it. It also may be not wise.
John, sorry to interrupt you. Can you just slow down a little bit, please?
Oh, sure.
I'm trying to write this down, and you're going a bit too fast.
Jay, is that Jay?
Sorry, John. I mean, yeah. Sorry,
Okay.
John. What did you say?
Yeah, I was just seeing if that was Jay that made the comment. So yes, I will try to speak slower. So basically,
thank you, John. You're an angel.
I'm sorry.
I said thank you very much.
Oh, you're welcome. So with the LLCs, just know that when we talk, most people will use that state's LLC for the IRA LLC purposes. But if you think you might want to potentially use an LLC in another state, for example, David, the gentleman from Florida, and he says, could I possibly use an LLC in another state? Yes, that's a possibility. It's all based on kind of what the transactions are probably going to be, which would probably dictate what I would suggest.
I have a quick question, Robin here. So I came a few minutes late. Other than tax reasons, are there any advantages of using my existing IRA to, excuse me, to fund a real estate investment like with John versus doing it outside? Yeah,
so I never make like an official comment on that because I'm not a financial planner. It's not my place to tell you what to do. And I know you're not asking that, Robin. Right. But yes, you have the tax advantages. And then realistically, most people, if you went up to most people percentage wise and said, out of all the funds that you have, personal, retirement, et cetera, what do you maybe have the quickest and most access to? A lot of people are going to say retirement accounts because personally, they may not hold a ton of money in their accounts, but they might have quite a bit of money sitting in a retirement account that can be used for this. And I do know this, and you heard me say before, I don't promote investments, et cetera, but John's investments have done very well over the years. So it's a great way to have that tax sheltering. Because obviously if you're coming in with personal funds, you're going to have some taxation of those funds with capital gains, et cetera.
Wait, so if I'm retired, so I'm not eligible for a new 401k or IRA. So if I wanted to do a self-directed IRA for real estate investments, I would have to take whatever that amount is and set it up separately, either as an LLC or something, right? In order to be able to do that investment through an IRA.
Correct, because your current IRA, I can pretty much with 100%
brokerage account. Yeah.
Yeah, they're not going to let you do that out of that account. They just don't. And by the way, for the group to understand, the brokerage firms legally can stop you from, and they just don't allow you, and they're totally legally able to do that because they can sell just the things that they sell. So yeah, brokerage firms just don't really do well with actually trying to set up a self-directed account. But to answer your question, Robin, is you don't qualify for the 401k, so we would be using a normal IRA, self-directed IRA custodian. But for the people in the room that have the ability to qualify for the 401k, some brokerage firms actually do allow an individual 401k plan to be set up where that trustee controls the account themselves, not Schwab or not Fidelity.
Thank you.
You bet.
I know you
Okay,
just said
yeah,
it.
no, that was great, Don. Thank you for all that information. We really appreciate it. Don Rubino, I'd like to kind of hand off to you if you want to talk about passive real estate investing and kind of give an overview of JID's take on
Sure.
this alternative investment.
Yes, sure. Jared, did you have a question, sir?
Yes. Besides capital gains tax, what else would you have to pay? Because I know the UIB or the UTIB we're exempt from, right?
Yes, so I'll hop in that with that, but then I'm going to pass that on to John as well, just from people who make investments not using retirement funds and how that's processed through the investment. But yes, was it Jared, by the way?
Yep.
Okay, Jared. Yeah, so with the retirement accounts, you're not going to have, generally speaking, that tax. But you mentioned, since you mentioned, I'm going to talk about it. You mentioned UBIT, and then a subsection of UBIT is what's called UDFI. So UBIT is where it's not illegal, but UBIT is where the IRS says if you have an IRA or a 401k, it cannot invest into active businesses. And the example I always use is McDonald's. You can't invest into active businesses and then get paid profits from that McDonald's based on sales without it triggering a tax, because an IRA or a 401k is intended to be passive in nature. So again, it's not illegal, but it would incur that UBIT tax, and that stands for unrelated business income tax. UDFI is a tax provision that the 401k is exempt from, not an IRA. But in the case of a UDFI, it stands for unrelated debt financed income. And it is simply where an IRA has funds invested into any project where debt occurs. It's not illegal, but your IRA can be potentially subject to a UDFI tax. And there's a formula for that. But that's a very good question.
Yeah, it's a great question too for us. We, David Schatz, our CFO, could help with that, but there are some instances where some of the investments inside of real estate could be applicable for UBIs. So something definitely to talk to your tax professional on, but most of our investments are usually not impacted with our company. So, hey, first off, again, I'd like to apologize for that outburst. Unfortunately, that happens. That's the first Zoom bomb I guess I've ever had. So sorry about that, folks. And secondly, I want to thank John for his time to coming out tonight and providing his presentation. It's a really interesting topic. And given where we're seeing things happen these days with taxes and some of the challenges that folks are trying to just either defer gains or to find some safe harbor, these are great tools. So we want to thank John for that. We've utilized John's services. Full disclosure, we don't get compensated. Neither does John get compensated from us on anything we bring over. John just does a fantastic job. We've got about a dozen of our investors of the 180 in our company that work with John, and they're very pleased. He's also provided information to folks that haven't used his services, but has still been available to provide some education and information. So thank you, John. I appreciate having you on board tonight. So a lot of folks on the call here, we recognize, we know you've been involved in passive real estate investing, but for folks that have heard of it before or syndication, really, it just allows you as an individual or an entity to utilize capital to come in and be part of a real estate opportunity, but have very limited not ownership, but roles or having to go out and deal with a lot of the active side of investing. So whereas if you buy a property and you own it and you have tenants, or you have a new construction project you're doing and you have a contractor, you're on the scene, you're liable for a lot of the day-to-day stuff, operations and management. Passive is a lot more hands-off, and it allows you the opportunity to participate and invest, and at the same time not be directly and actively involved in a project where you're actually controlling it or operating it. Pros and cons, actively you get to make the decisions, you get to control the day-to-day operations and management. The downside is obviously if there's huge corrections to the market or a downshift, or if you're guaranteeing debt loans or recourse, there is some potential liability there. On the passive side, the real risk typically is that your money is exposed. A lot of these investments on syndication are non-collateralized investments. So you just have to be real. You have to just realize that that is a risk, that you could lose your money. But at the same time, you don't have to deal with a lot of the liability as an active owner. The benefit of a passive investor is if you're a salaried employee or you own a business, or this is not your full-time job, you can invest in these types of opportunities just like you do in a stock or a mutual fund or any type of alternative investment and have an opportunity to do this without having to be involved with it directly day to day. So it offers great opportunity. I'm sure everybody's read Rich Dad Poor Dad. This is what Robert Kiyosaki, what we offer, and what these types of investments are as the private placement investments that his rich dad and his rich friend were involved in. So these are the type of projects that are typically only available to accredited and high net worth individuals. Although there are some projects that are out there and investments that are out there that are also open to non-accredited sophisticated investors. We typically call those a Regulation D 506B as in Bravo, and you can look that up and we can provide you more information if you have interest. But typically these types of investments involve a higher level of risk and are only open to a certain segment of folks that qualify either through income or net worth. So investors should always obviously consult your trusted agents if you want to get involved in passive investment. There's a lot of platforms that are out there right now, like crowdfunding websites that you can jump on and you can potentially invest passively. We'll talk to you a little bit more about what we do, but obviously consult your CPA, your attorney, and your trusted advisors if you're interested in getting involved in this. There's also other folks that are more kind of key to investments in these types of asset classes and these types of investments. A registered investment advisor or an RIA would be a good person to have on your team just to talk to if you want to get involved in things like DSTs, 1031s, opportunity zones, which we also offer. But an RIA is kind of more of an alternative investment specialist that focuses really in those areas and can provide you good insights similar to a certified financial planner or advisor. That's just a key there. Obviously, anytime you're going to put your money into anything, make sure you do your homework. We have a very methodical process, which we'll talk about here in a second very briefly. But you want to make sure you do your homework, make sure you do due diligence, understand who you're going to be investing with, do the work and research to understand who they are and what they've done. And given the fact that we have an inordinate amount of information at our exposure on the web, and also asking these people for the information you need to feel comfortable, make sure you do your homework. So go to the next slide, Dave. So we want to just really go through a couple of things here. How does this work? So typically you're going to have a developer or sponsor when it comes to passive real estate investment that's going to lead the charge. They're going to be in charge of the project. They're going to basically take it from start to finish. They're going to walk you through the process, and they're going to be the ones that really are managing that day-to-day active side of the business. So you want to get to know them really well, make sure you're comfortable with their experience. Who are the people on their staff and the people that they're going to be utilizing to operate and conduct the project? How have they done in the past? Have they had some struggles? Are they willing to share the good news and the bad news with you? Strong financials, making sure that they have good financials and that they know what they're doing, that they're typically bringing in the money that they're asking you to bring in at some percentage. We typically like to see about 10% of the money we're bringing into our deals that's coming in from the sponsor, and they're putting up as well for their projects. Obviously, find references, go out to those folks that work with them, whether it's their banking connections or their lenders or their construction teams and their contractors that they work with, their architects. Make sure that you get copies of the legal documents. Make sure you go through what's called an operating agreement, that you understand the ins and outs of how they operate when they put a deal together to advertise, and how that things like the distributions are treated, how you and your capital is treated on your initial contributions. If there's anything like capital calls, which is additional capital that's required on a project. So make sure you go through that. And if you don't feel comfortable going into it on your own, definitely talk to your trusted agents to have them go through, especially your attorneys. And make sure not to feel like you can't ask questions. Again, this is your money. If you need information, if you want to meet with these folks in person, you have every right to. So the first thing we're going to always do with our company, JIDI, is we're going to always look at the developer. We're going to build that relationship, make sure everything is a good fit for us. They see the value we bring to them, and then we start looking at their opportunities. The next thing we're going to look at is the location of the real estate project. We're going to look at the population, the people in that area, what's attracting a real estate to that area. Right now, we really like the Mid-Atlantic, the Southeast, DC, Maryland, and Virginia, because that's where a lot of the population growth is. That's where the jobs are. That's where the living conditions are very ideal. and that the weather's good, and people like those areas. That's where they're heading to. So markets like Charleston, South Carolina, Atlanta, Georgia, Charlotte, North Carolina, these are the markets that we're really attracted to because of the things that you see there that we're looking at when we analyze a project. So the most important thing we look at too then is, how is the money put together? So we can put up the next portion. We call this the capital stack. And typically the capital stack's made up of a debt lender, someone that's going to bring in the majority of the money, typically a bank or a real estate investment trust, somebody that's bringing in what we call senior debt. The next one on the list is usually going to be either junior debt or a preferred equity group that typically is made up of high net worth individuals, a family office, a pension fund, that's usually bringing in anywhere between $10 to $50 million of preferred equity. And they're usually batting second in the batting order behind the bank. They don't get as high of a return as we would, which is the next group on there, the general equity, but they're also not getting, a 5 or 6 or 7% interest rate on the money like the bank is. The benefit for the bank is they get first position, they get recourse. And so if anything happens, they take ownership and they're able to go after the sponsor personally if it's a recourse loan. Preferred equity, unless there is collateral offered, is usually in a second position behind the bank. General equity is where we come in. We typically are providing about $1 million to $5 million a project. And for that, we come in as what's called a limited partner or a co-general partner. And that money comes into the ownership entity of the project, and we are afforded higher returns, but being kind of the smaller pot of money in the project. And so if you want to go to the next slide, Dave, or just the next piece. So here's just an example using some of those percentages above, and you can see those there. We're typically at the, you can get the next one, Dave. We're typically at the general equity piece there. We're coming in for that slice of general equity to get the sponsors much needed funds that they need. That is going to cost them typically what we usually shoot for is around a 25 to 35% a year return on our money. And the reason why is because, again, these are very high risk projects. We're usually coming in at the development stage when there's land, either as raw land or developed and entitled land, pre-entitlement or pre-permitting. So we're committing on what's called the horizontal piece of the project. And then we can also stand for the build-up or the vertical piece of the construction, which is called. And so we can come in either phase of that. And for that, we typically charge a higher return. We have what's called a waterfall or distribution schedule, which is usually how we're paid out on our returns. So that distribution schedule gets us our money out of the project. And then we have our own private placement memorandum. We have our own entity that basically dictates how our investors who participate in a deal can basically be compensated or how they get their returns for a project based on what we earn. And typically what we're trying to advertise when we provide is about a 12% preferred return a year on investors' monies, and then return of capital before our company takes any profits on a project. And once that's met, we get what's called our promote or catch up. And then we're usually splitting our profits 60-40, 65-35, or 70-30 in favor of the investors to get them a return of around a 15 to 20% a year. So that's what we're typically shooting for. A lot of stuff there. Again, we'll be able to talk to you offline and you can have access to the presentation. But that's typically how we put it together. So these are some of the projects we're currently executing on. We got some wonderful projects here in Washington, D.C., Frederick, Maryland, Richmond, Virginia, Fairfax, Virginia, and Charlotte, Atlanta. So we're kind of all over the map there in the Southeast. We've invested on 28 projects to date, over $33 million in investment capital. We've gone full cycle now on 18 deals. We just finished one of our largest projects here in Southwest D.C., and we currently have 10, soon to be 11 projects that are thriving real well, even given the challenges we were facing in COVID. You can go to the next slide, Dave. So this is just kind of some basic information about us. What we try to do is we try to be that kind of liaison between you, the investor who wants to invest in a project at a $1 to $3 million or $1 to $5 million level. We want to do all the homework for you. We want to do the due diligence. Our business offers those kind of services to bring you a project that we kind of stamp with our seal of approval that we're going to put in our own money, and we want to advertise to you, our investors, if you join us. And so our investors are seeing those deals. They're actually having the opportunity to participate. And so again, we want to work between you, the investor, and the sponsor, and give you the opportunity to take a look at some of our deals. All right, we can go to the next slide. And we're just about finished up, and we want to open the floor for questions. So we just wanted to highlight some of the second and third quarter highlights we've had. Our Juniper Square portal that Dave manages has been fantastic. If you're not familiar with Juniper Square, it's a wonderful portal. Provides investment information, just like if you were to log on to your Morgan Stanley or your money management website. Today, we've got about 175 investors and growing, and we're continuing to raise money for some great projects. Like John said, you could use your self-directed IRA or your 401k or trust to invest in our projects. And on the bottom there, these are some of the deals that we've actually raised capital for, and we're getting ready to raise money on. So you can take a look at that. We've got a great new project coming out next week down in Charleston, South Carolina, which will be available in the next few days. That'll be a 506C, which is open to accredited investors only. So we'll be looking to raise money for that investment. And some of our other projects are making some great milestones and hitting some great returns. So we're really proud of the performance, and we're excited to have you all on. And hopefully, if you'd like to hear more about what we're doing, reach out anytime. So with that, if there's anybody that doesn't have if anybody has any questions, anything we can help answer for you, or any questions about JID or what John's doing, please feel free. Jump on, please. I saw one question from Brian about interest rates. Yeah, Brian, interest rates are, thanks, Charlie, are obviously going up. They're not coming down. And what we're typically looking at in our deals now is making sure that the interest rates are comparable to what the market's showing. A lot of the interest rates and a lot of the deals we're seeing already have these higher interest rates baked in, but we're seeing usually around a 5 to 7% rate now since the rates have been going up. We're also looking at higher contingencies, usually 10 to 15% contingencies for construction costs and costs, just to take into consideration. But yes, interest rates are really important to look at. Most of the sponsors we're working with do have locked in rates for the first year to two, and then it's floating or variable, but we still have really good profit numbers that are built in to compensate. So hopefully that helps. Any other questions?
Hey, John, Tony 10.
Hey, Tony.
Hey, so with the, what it looks like the economy is slowing down here for who knows how long. How do you see the projects that you guys are bringing online? How do you see the profitability of those projects and real estate investment as a whole here in the next couple of years?
That's a great question, Tony, and we're going to have a beer and talk about it more when you get back. But what I look at is that it's kind of normalizing now. We've had a pretty frothy market for the last 2 years with COVID. We got hit with COVID, and then all of a sudden people realized, wow, we could still do really well with multifamily, which is typically what we're focusing on. But, with interest rates going up, it's going to make it a bit of a challenge on the lending side. We're starting to see lenders kind of reduce what's called the loan to cost value, which is really that percentage of capital that the banks are willing to lend on. So they're preventing more of leveraged or levered debt. So that's going to require more investors to come in and more private money, which is going to cause those margins to come down a bit. But the projects that are doing well are the projects we're seeing from our experienced sponsors. Those folks that have weathered the storm, have been through a few cycles, so they know how to handle these things. And my golden rule is always, you're making your money on the front end of the project, not the back end. So if you're getting into a deal with very conservative numbers, building in a 20-30% drop in the market, and still can hit very reasonable and favorable numbers, which for us, I like to use the baseball analogy, hitting a double. If you're hitting a double or better, we feel very good about those projects. We're also seeing a really, historical low in the supply market as far as what's available. There's not a lot of housing out there right now. So a lot of people who want to go to these great markets like Charlotte and Atlanta and Charleston, they're willing to pay top dollar for these properties. So, and if they're not buying, Tony, then they're going to rent, which is good for us too, because we have a number of projects right now that are looking for tenants. So that's going to increase the appreciation on the rental growth. So yeah, there's a lot of different things that we're seeing, but the overall foundations of real estate around are solid. I was listening to a great guy the other day about saying that the recession of '08, the Great Recession, was really centered around real estate. Real estate kind of caused that with the banking and the finance and real estate. But right now it's not really directly from real estate, and real estate really isn't the core concern as far as what we're seeing. So there's going to be some ups and downs, but yeah, our projects we look at, they're still very solid. We want to go in again, hitting a double or better. And a lot of the parameters we're looking at is, poking holes in these things to make sure that if we do get another rainy day, we still perform very well. So hopefully that answers your question. I'll take you up on that beer when you get back.
All right, thanks.
Any other questions from folks? We'd love to hear from you. If you got any comments, please feel free. We'll give you guys another minute. And if not, we'll sign off, but we're really happy to have you all here. Thanks for your time. And again, apologize for some folks there, but I guess it tends to happen.
Hey, John, Tony, sorry, I have so
That's
many
okay.
questions tonight.
No, you're good.
Can you go back to the slide that had the future, your future projects? And
Yeah, that's a good idea. Let's go ahead and go back to the second quarter. Yeah. And Dave, if you hit that bottom right, you should be able to blow that slide up. If not, that's fine. You can leave it. But yeah, we've got some really good projects, opportunity zones. We talk about that a lot now. Opportunity zones, unfortunately, you won't be able to use one of those self-directed IRAs or solo 401ks because it is a tax deferred investment. So you're basically going to be able to take a capital gain that you liquidate from a stock or selling your business or any type of gain that you earn, and you can defer it into an opportunity zone. So that affords some great incentives. I won't go into it in detail, but you could talk offline, Tony, if you have interest on that or anyone else, but it's a great investment. And we're in 2 opportunity zones right now, one in Ohio and one in Columbus, one in DC. Our largest raise this year was a $5 million raise for 2 projects. Some folks on the line are in those deals in Fairfax, Virginia, and in Charlotte, North Carolina. Those projects are doing fantastic. We're scheduled to break ground by the end of the year. We'll have another round of capital raise probably first quarter of next year for the construction phase. So we're going to probably advertise that out. So I recognize everybody on here. You'll get that announcement here in the next couple of months. So keep an eye out for that. This new project down in Charleston is really exciting. It's a 506C, so I could talk about it till I'm blue in the face, but it's really neat. It'll be 21 luxury condos with about 9,000 square feet of retail and commercial space. And the luxury condos are going to range from about $1.8 million to $4.5 million in sales. And I know that scares the heck out of you in a recession, but here's the good news. They've already pre-sold 12 of the 21 units. So that's unbelievable. We're walking into a deal with 57% of the product already pre-sold. We're going to be advertising about a 16% return with a 12% pref, and it's only a 2-year project. So you 3 folks on here who are JID investors, and John, you too, you're on here, I know. That's going to be fantastic. So I highly recommend. We should have the announcement out tomorrow and the summary probably out early next week with the PPM shortly to follow. I know a lot of folks on here are involved in our Peninsula 88 project. So I'm really happy. Thanks, Andrea. We're really happy to have that one finished. Our investors are really happy considering the challenges we faced with COVID. But we did fairly well. Actually, we did really well considering what we dealt with. And you can see some of those returns down there, some strong equity multiples and returns. So we're really proud to have that one done. That was a $4.5 million raise, 4.4 million. And we realized just over 4.2 million in profits. So that's pretty darn good in my book. And then we've got our Rhode Island Rialto project that's over 50% leased up. We're looking to get that one on the market and sold probably right after the new year. So they'll keep an eye on that if you're a Rialto Rhode Island investor. And then our Edgewood Indy project is leasing right now. Fantastic project. Actually, you can see it on the lower left, my picture there on that slide. We topped out about 3 weeks ago, and we're starting to lease up. We should have that one sold by second quarter of next year. The returns are just ridiculous. Right now, we're projecting over 20% a year on that project, even with the delays, if we hit our numbers. So really exciting. We got a lot of great things in the pipeline. We're looking at a couple of more deals in Ohio for Opportunity Zone, and a couple of senior living projects in North Carolina. So we'll keep you posted as always. And let us know if you have any questions. Thanks so much. Any other questions, Tony? You're leading the charge.
No, John, thanks. And John
bet.
Park, I'll be in touch here soon.
Excellent. And Charlie and Andrea, and thank you so much for coming out and staying on board for the full time. And hopefully we added a couple of good things there. Andrea, you look great in that picture. And your significant other there. I won't say your better half. You're the better half on that. But we're just so grateful for you. And Charlie, we're going to be recapitalizing out some capital in Columbian Quarter and Bridge District. So keep an eye out for that one. We should have that out in the next 2 weeks. And we'll be able to give you the opportunity to come out if you're interested, or you could stay in if you'd like to stay in for another couple of years. So keep an eye on that as well. So you guys come to these webinars, you get more than just educational information. You get a lot of good details. John, I want to thank you again for coming out. We appreciate it. And please, folks, if you guys want to talk to more to John, please do. He's a fantastic resource, and we're grateful for our relationship and partnership with him. So with that, I'm going to be quiet and let you guys go. And unless there's no by the ways, Dave, if you want to wrap it up, I think we should be good to go.
Absolutely. Thanks, John. John Park, appreciate your time. Thank you, everyone, for coming, and we'll look forward to seeing you at the next one.
Thanks, guys.